Hello and thanks for joining us at interest.co.nz. I'm Tibshraeny and today I'm joined by Reserve Bank Chief Economist Yuong. Good to see you, Yuong.
Good to speak with you again, Janine.
Look, a lot has happened since the Reserve Bank released its monetary policy statement just last week. We have this new variant of COVID-19, Omicron. I understand it's early days and scientists are still trying to understand, how exactly this variant works and what it means, but to what extent does the Reserve Bank see new variants like this as hurdles to it removing stimulus from the economy?
Yeah, it's a timely question, obviously, given the news on Friday. I think it just sort of plays into the balance of risks in the assessment we had at the time of the MPS. We noted there were a number of upside risks to our inflation and employment outlook, but also equally, and just as importantly, there were some downside risks, principally around the fact that COVID's still around, and if anything, we're transitioning into a world where we're going to have to get used to living with COVID. It was Delta, but now it's a new variant. And then basically how households and businesses respond to that, I guess, the pervasive uncertainty with COVID in the community. So it hasn't fundamentally changed our picture, it's just reinforced that there are still huge uncertainties and big risks on both sides to our employment and inflation outlook.
Okay, so you're saying, and the bank has actually talked about COVID being endemic, so us learning to sort of live with it, and you've been factoring that into the work you've been doing.
That's right. I mean, what we sort of think is, what we observed in coming out of the previous national lockdown was a massive recovery in pent-up demand and spending. But that was a world where we were entering into an economy with no COVID. We'd largely eliminated. But this time round, we are sort of coming out of these variations of lockdowns with living with COVID in the community. So we just don't know how households will respond to the nature of the uncertainty. Will they go out and spend to the same degree that they had in the previous lockdown? Will investment plans come back on stream as quickly as they did? So that's the sort of stuff that we're working our way through. So there is still a lot of uncertainty that we see, but we are starting from a position where the economy, by and large, has weathered the worst of the COVID storm and is in a pretty resilient position in terms of both the inflation outlook and the employment outlook.
Yuong, some people will look at the current situation and wonder to what extent can higher interest rates actually solve the higher inflation that we're facing, and this is largely because a lot of the higher prices are coming from international factors that we can't control, like those supply chain issues. And if Omicron turns out to be a big thing, then it'll cost more to ship goods around the world, and travel might be restricted and all that, and that puts up prices. How much can high interest rates do, other than just, I guess, suppressing some demand?
Yeah, it's a good question. We get asked that a lot, why is monetary policy doing what it's doing? And it's probably fair to say that if you abstract from the global supply chain shortages, which are currently accentuating the high inflation we're experiencing, we are still actually entering a world, an environment where inflation pressures are rising and have been rising, and that reflects just the resilience of the domestic economy. So if you think about capacity constraints, the global shortages are just simply adding to a domestic economy that's already running, I guess, in our language, above potential. So labour shortages are pretty acute, particularly in some industries. Costs are rising, accentuated by current supply chain shortages. But it is an environment where generally inflation pressures are rising. If you look at our suite of core inflation measures, most of those are now sitting in the top half of our 1 to 3 band, whereas you go back 12 to 18 months, they will be sitting in the bottom half of our 1 to 3 band. So in that environment, we feel that while we put in low interest rates and significant stimulus for the past 12 to 18 months, it's now time to be removing that stimulus as the economy transitions into this new environment.
So regardless of these international
issues. That's right. And the big issue for us really is how long or how persistent will these global supply chain shortages and the high inflation that comes with it, how long will they sort of persist into our domestic supply chain and cost structure? So we just alert to the risk that these things might linger for longer, and in that case you might worry about sort of higher medium-term prices as a result of businesses trying to catch up as margins are squeezed.
What did you make of the market reaction to the Reserve Bank releasing its monetary policy statement?
Oh yeah, we were very conscious that market pricing had moved a long way in a short space of time. So perhaps no surprise that on the day, some of the market interest rates fell back a little bit because they were pricing in the possibility that we might raise the OCR by 50 basis points. So you get a little bit of on-the-day repricing. But when you sort of look at the broader span of time between August and the November statement, we had observed that interest rates had tightened, had increased quite significantly, and that was broadly in line with how our outlook for the economy had evolved, that we continue to remove stimulus, and if anything, the data that we had seen since August had printed a bit stronger, so it seemed to be moving in the right fashion. So overall, we're pretty comfortable with where monetary conditions are sitting.
Okay, do you expect to see quite a bit more volatility in these market rates? I'm thinking particularly as we're seeing this new variant come along and, you know, markets react. Markets always react, this is nothing new, yeah. Things happen and they react and pricing changes. But to what extent does COVID just exacerbate all those existing issues?
And that's the thing we'll be looking into. So I think it will add more volatility, but it's interesting if you look at sort of the global discussion on central bank monetary policy, it has increasingly shifted from keeping stimulus in place to now wondering how persistent and how prolonged some of these supply chain and inflation pressures will be. So for New Zealand's case, we've actually undertaken a couple of monetary tightenings already. Globally, that discussion is still to be had, but it's increasingly moving towards, sooner rather than later that monetary policy stimulus will be removed. No doubt the latest Omicron variation will create a bit of volatility, but will be enough to unseat some of that discussion about how persistent and how high the inflation pressures are coming through in the global supply chains.
Okay, another constraint, I guess, to the Reserve Bank hiking interest rates is the high level of household debt that we have, and particularly a lot of people have taken on very large mortgages over the past year or two. Mm-hmm. How, of all the things that you're weighing up, how much of a constraint is that, or how much weight are you placing on that issue as you're assessing all the different factors here?
It's an important consideration. I wouldn't see it as a constraint. I mean, that's partly how monetary policy works, right? So we lower interest rates, it makes borrowing, increases cash flow for those with debt. Likewise, as we're now removing stimulus and raising interest rates, it will just constrain cash flow and potentially spending as a result, and that's just typically how monetary policy works over the cycle. What we're particularly keeping a keener eye on is just noting that for a lot of people who took on debt, it's probably the first time they'll be facing a material increase in interest rates, and given where market interest rates have gone, it will be quite a large increase they'll be facing. So we just have to be sensitive to how households and businesses respond to those sort of higher interest rates that have been priced into the market to date.
A lot of people might be thinking, well, isn't it interesting, you take the elevator down and then you take the stairs up, seems to be the way with monetary policy. So what do you say to the criticism that the Reserve Bank is more cognizant of monetary policy and the way it flows through the housing market now that it's tightening versus when it was loosening?
I think it just speaks to the nature of the risk and the balance of risk we were facing. We loosened, and like other central banks, loosened significantly. Largest declines in cash rates and any number of alternative monetary policy tools. We're throwing the kitchen sink in it, mainly because the balance of the risk we're facing was so stark to the downside and the uncertainty we were facing. On the way back up, we think we've got a better handle on the nature of the risks, and they are equally balanced at the moment, both on the up and downside. So that's probably why people view when you stand back and go, well, quick to ease, more measured on the way out. It's just reflecting the nature of the risks we're facing.
Okay, the large-scale asset purchase program, that's another tool that the Reserve Bank has been using to loosen monetary policy. For people listening, that's the bond buying or the quantitative easing. The Reserve Bank now has a large portfolio of these New Zealand government bonds that it's bought. Yuong, next year the bank's going to give us some more details about how it's going to manage that portfolio. But can you tell us whether the bank will actively try to sell or actively sell some of those bonds ahead of them maturing?
Well, that's the discussion that's still to come. So no decisions. The work's still is still being carried out in terms of how you would actually manage down the portfolio of bond holdings that we have. At a very high level, you've got the two opposite extremes. You can say, well, we fully reinvest our bonds as they mature, so you maintain that portfolio. We don't think that's a starting proposition, but that's one option. And the other option is basically we don't reinvest the bonds as they mature, so the bond portfolio will naturally wind down. the idea of whether actively selling the bonds, we haven't actually discussed what that would look like yet. The bottom line is we want to maintain, decent market functioning. So how will we manage down the bond portfolio? Will be with that market functioning mindset guideline in mind there.
Okay, I just want to be clear. You said you haven't actively discussed this issue of whether you sell the bonds. So does that mean the bank is that's not kind of one of the options at the moment?
Well, it's still being worked out. So we would have to consider our impact on the bond market. We'd have to have discussions with New Zealand Debt Management as they issue bonds on behalf of the government. So those are sort of the logistical and operational issues that we have to figure out, how you would actually manage down our current holdings of LSAT bonds.
Yeah, but that is an option though that's on the table?
I don't know where it's got to. The work's still being carried out by staff.
Okay, but one option is definitely just letting the bonds as they mature, letting them roll off. That's definitely an option. Another option is reinvesting some. So some you might have, 200 million mature, then you reinvest 100 million.
That's right.
So it's not a big drop off all in one day. So you're considering those options, but you're not considering selling them?
Well, under the current terms of the indemnity and the agreement, the MOU we have with the Minister of Finance, the only way we could actively sell the bonds back before they mature would be back to the New Zealand Debt Management. So we couldn't actively sell the bonds into the secondary market. So it would be basically cancelling our bond portfolio and then selling them back to the New Zealand Debt Management under the current MOU we have.
What's the rationale behind that being set in place?
Well, the rationale essentially, New Zealand Debt Management are issuing bonds on behalf of the government to raise its funding profile. If we were to also sell our LSAT holdings back into the bond market, it would just be an interesting look where you've basically got the Reserve Bank selling bonds and New Zealand Treasury selling bonds. So from a market functioning point of view, we want to make sure we're coordinated in terms of market functioning, that we don't have this sort of a two-system market where both the Reserve Bank and the Treasury are selling bonds into the New Zealand bond market. Okay,
Yuong, look, excuse my ignorance on this, I'm sort of thinking on the spot here, but a large issue with when the bonds were bought by the Reserve Bank was to ensure that the Reserve Bank and the government were separate. So the Reserve Bank had to buy these bonds from the secondary market. So that's from other investors that had already purchased them from Treasury, from Debt Management Office. So to create that separation. But now when we're unwinding it, there's less of a separation. The deal is that debt management has to buy them, so the government has to buy them.
Well, it's about being coordinated and understanding our impact on market functioning. So certainly when you're actively selling bonds into a market, you've got to be mindful about the investor pool and market functioning. So under the MOU agreement we had, it was pretty clear that the only way we could sell our bond portfolio early would be through coordinating with the New Zealand Debt Management.
Okay, so just finally to get a clear understanding on that, from what you're saying, it sounds like the likelihood of the Reserve Bank selling the bonds back to the government is a bit lower than the likelihood of the Reserve Bank just letting the bonds drop off.
Oh, I'm not going to...
You're not saying...
I'm not saying that at all.
Okay.
I'm saying that the work is still to come. But in terms of the current agreement we have, that would be how we would sell our bonds earlier, before maturity.
Okay, look, just on to staffing at the Reserve Bank. I note that you are departing in February after nearly 25 years at the Reserve Bank.
That's about right,
over the time. Yeah, look, just wondering, over that time, how has working at the bank changed? There's been a lot of change to the role of the bank. Just interested in your observations of that, the change over that time.
Yeah, it's...
Big question.
It is a big question. I'd say there's a lot more awareness of the role of central banking in society, and hence with that comes a lot more critique and a lot more questioning, which is a good thing. And likewise, from our point of view, we've got a lot more onus to actually explain the impact of our actions. How we are contributing to the broader economic prosperity of New Zealand, in terms and then hence. Why we're doing what we're doing with our particular policies, be it monetary policy, financial stability, and even on the money and cash side. I think, if anything, a growing awareness of the importance of money in society and the payment system. That's probably the untapped and new and exciting area for policy, for central banking, as from where I sit. So I think there is just a greater appreciation and hence greater scrutiny of central banking in general.
Okay, and in terms of your next role, you've said you're coaching your son's cricket team. That sounds like a big job. Anything else lined up?
No, I'm just keen to take a break. It's been a busy few years, and in a pretty good position to be able to sort of take some time out, and yeah, just reassess. But certainly looking forward to the break. It's the last 3 or 4 years have felt like I've been on fast forward, so it'd be nice to sort of slow it down a little bit.
And that's the reason you're leaving the bank?
That's the reason.
Okay, Yuong, thank you so much for your time. Appreciate it, and appreciate you always making yourself available after these statements too. That's much appreciated.
You're welcome.
Thank you.
All right.